class, you're going to look at what is trading, spot trading, market order types, and under market order types, you're going to look at what we call market order, the limit order, the stop limit order, the OCO, and all that. Then you're going to look at trading basics, what every beginner should understand. Then you're going to have smart trading habits, and lastly, essential trading terms. So let's start from the top. What is trading? Number one, trading. Let me just. Okay, it's recording. So trading is simply means swapping one thing for another, like exchanging goods or services or money. So when it comes to crypto trading is about trying to make money by guessing whether the price of a coin like Bitcoin will go up or down. So you can also trade by buying and selling cryptocurrencies directly on special apps called crypto exchanges. What did you say? Crypto exchanges, or rather two types of crypto exchanges, or three? Let's look at the two main types of crypto exchanges. Tell us a crypto exchange and define it. Two types of crypto exchanges. Two types of crypto exchanges. Joseph?
Centralized exchanges.
Yes, we have what you call centralized exchanges. Under centralized exchanges, what do you say centralized exchanges are? Joseph?
Owned by a central body.
Yes, owned by a central body. An example of a centralized exchange?
Binance, Bitget.
Yes, Binance, Bitget, OKX, all those are centralized exchanges. Another type of exchange, someone? Another type of exchange. We have looked at centralized exchange. Another type, use?
Decentralized exchanges.
Yes, define them.
They are not controlled by a central body.
An example?
Uniswap.
Yes, Uniswap, PancakeSwap, SushiSwap, KuCoin, all those are decentralized exchanges. So in short, crypto trading is about trying to make money by guessing whether the price of a coin like Bitcoin will go up or down. You can also trade by buying and selling cryptocurrencies on special apps that we call what? The crypto exchanges. So trading basics that every beginner should understand. Number one, trading won't make you rich overnight. People have a mistake of thinking that you're going to build wealth overnight. So number one thing you should understand, trading won't make you rich overnight. Building wealth through trading takes time. That's one. Learning and a lot of patience. So it is unrealistic to expect fast riches just by entering the market. Number two, trading basic. Trading alone is a risky way of earning a living. So the markets can change suddenly. Like I said the fundamentals are much stronger than the technicals when it comes to crypto. So the markets can change suddenly. So therefore, nothing is guaranteed. So some days you might profit, but on others you might face big losses. Number three, relying on trading bots can lead to big losses. So automated bots don't always make the best decision. You could lose a lot of money if you blindly trust bots without proper oversight. Number four, winning and losing are part of the game. You should always understand that. So you might enjoy a series of while, however, losing streaks are also very common. It's part of the trading journey. So it's in short, when it comes to trading, or rather futures trading, what we say is the goal is to make sure that your wins are more than your losses, or your losses are less than your wins. Meaning that and we're going to look at that when you're talking about risk to reward ratio and stuff like that. You're going to look at how you can ensure your winning streak are many than you are losing streaks. Common reasons why traders lose money. Number one, unrealistic expectation. Many people, or rather, many hope to flip $10, you can imagine, to $10,000 instantly, which is not how real trading works. Number two, bad risk to reward ratio decisions. So they risk too much for little potential gain, which quickly leads to losses. We shall look at this way later in the course of this week, so do not worry. Then number three, over reliance on bots. So trusting automated bots to do all the work often ends badly without proper oversight. Lastly, or number four, and this is very common, letting others trade for you. So giving money to a professional in quote traders creates pressure and leads to poor income outcomes. So it is better for you to understand how trading works on your own. Try it because when you're trading on your own, you'll be able to risk in accordance to your risk appetite. Remember, if you give someone to trade for you, they don't have the pain, or rather they won't feel the pain of that money. So they can decide to have crazy risk reward ratios, crazy what we call leverage. You shall look at that later. Crazy leverages, meaning they have very, very poor risk management because they ideally they don't have the pain of that capital that you've given to them. Number five, emotional decisions, buying out of fear or hype. Remember what we called about FOMO. Instead of doing research, you buy out of fear or hype, and that will cause costly mistakes. Number six, ignoring risk management. Very important. A lot of people will trade without stop losses, without calculating their risk reward ratios, without calculating their leverages, all that. So we are saying ignoring risk management strategies will lead to what? Or examples is failing to set stop losses or limit exposure increases the chance of big losses. We'll have a separate class when we'll be talking about risk management strategy. Number seven, breaking their own rules. Many don't stick to their trading strategy or set boundaries, leading to reckless trades. For example, you might have, maybe your rule is I only trade 3 times in a day, 3 setups in a day. You enter into the market, all your 3 setups are in profits. You've won all those 3 setups. What do you then think about? Greed. Greed gets into you. You decide to trade another trade, and you might find mostly if you break your rule, the 4th trade that you've decided to take might be a losing streak that will actually wipe all your profits for the 3 winning trades. So do not break your own rules. Stick to your trading strategy and stick to your set boundaries. Number 7, we've lost count, maybe 8. No clear plan. Without a trading plan, it is easy to get lost and make impulse moves. The last one, greed, and greed again. So greed takes over. Instead of taking profits, they keep holding on for more, and you oftenly lose everything. For example, when you're doing your analysis, you'd said, let's assume your trade was on Doge. You'd said that if my profit goes up like 50%, I'll be out of that trade. But greed takes over, and you decide, maybe let me see if my percentage profit will push to maybe 80%. What happens? A negative fundamental news happens, and the market goes down. Now, your greed will lead to losing everything, inclusive of the profit that you had initially made. So we have looked at bad habits that traders have. Let's look at the smart habits that every trader should develop. Number 1, take breaks in between tough markets. So when the market feels off or choppy, we look at different market types. Choppy is what we call an accumulation. So when the market is on an accumulation, or when the market is feeling off, step away and protect your mindset. For example, April was a very funny month where everything in crypto, or rather in the financial market, was being controlled by Trump and his funny tariffs. So if the market feels off, take breaks and stay away from the markets. Number 2, avoid over dependence on bots. Bots can help, but they don't replace your decision making. So it's better to learn on your own and make your trading decisions independently. Number 3, don't let others trade for you. I've seen people making this mistake. Don't let others trade for you. If you're not confident to manage your own trades, you're not ready to risk your own money. It's better to stay with your own money instead of giving someone to trade for you. It's better you even invest in other things. Invest in other traditional ways. Go and buy Bitcoin, hold it for long instead of giving someone to trade for you. Number 4, control emotions and greed. Fear and greed are the biggest account killers. So stay calm and stay logical. Number 4, take small but consistent profits. So aiming for steady wins over time beats trying to hit the jackpot. So for example, if your account size is $10, take small but consistent profit. So it's better to take $5 daily rather than waiting or rather having an over expectation that your $10 can turn into $10,000 over a one single trade. So it's better to aim for steady wins rather than trying to hit a jackpot. Number 4, limit your daily trades. Quality over quantity. It's better to trade 3 to 5 focused trades are better than 20 random trades. The next one, avoid trading every day. So some days are good to trade, some days are not good to trade. So only trade when you see an opportunity. Wait for a clear opportunity. So according to your trading strategy, if you go to the market today and you're seeing that there is no clear opportunity according to your trading strategy, it's better to avoid that day. Remember, the market is going nowhere. It is here. So be patient until you have a clear opportunity. That's the time you'll dive into the markets. Then protect your capital. Protect your capital. This actually should be point number 1. Protect your capital. Good traders prioritize not losing money over chasing big profits. And under this, we'll see importance of protecting your capital when we will be looking at risk management strategy. So hold on to that. When we're looking at risk management strategy, we'll dive into that in depth. The last one, stick to a trading plan. Having a clear strategy helps you to avoid random trades. So we have looked at 3 things. We've looked at what is trading. We have looked at the trading basics. We have looked at common mistakes why traders lose money. Then lastly, we have looked at smart habits every trader should adopt. So a question, someone to give us any trading basic that they can remember. Any trading basic you can remember that you've mentioned? Any trading basic that you can remember? Any trading basic that you can remember? We've looked at trading basics, we've looked at bad habits, and looked at good habits to have as a trader. Joseph? Joseph, we can't hear you. Any trading basic?
Trade when an opportunity comes.
Yes, trade when you see an opportunity, not random trades. Mula?
Don't trade every day.
Do not trade every day. Paul?
Trading won't make you rich overnight.
Yes, trading won't make you rich overnight. Pius?
Have a trading plan.
Have a trading plan or a trading strategy. Yes, Sly?
Take small but consistent profits.
Yes, take small but consistent profit. Do not take a screenshot, take profits. Levi or Levi? Levi?
lot of dependence on bots.
Yes, do not rely on bots. Let's appreciate all those kindly who have participated in that. Perfect. So from this point right here is the most essential part that I'll need you to understand and understand very well, because you'll need this when you're doing spot trading, and not only spot trading, you'll also need to understand this when be looking at futures trading. It's what we call the essential trading terms, market, or rather market order types, the different market order types that exist. So let's start with the first type of market order. Number one, what we call the market order. So this is an order to quickly buy or sell an asset at the best available current price. So market orders are executed instantly at the current market price. And I'll give an example. For example, the current market price, I can't remember the current market price of Bitcoin, but let's assume the current market price of Bitcoin is 94,126K. So if I want to buy at the exact current market price, I'll use a market order type that is called a market order. So they are executed instantly at the current market price. So this is the most straightforward kind of trade. You just click buy or sell and it happens instantly at the current market price. So it is fast and guarantees your trade will go through. But you might not always get the exact price you expected, especially in a fast moving market. That's the first type of market order type, the market order. Executed. The main important thing you need to understand that it is executed at the current market price. Number two, we have what we call a limit order. So this is when a trader sets a specific price at which they want to buy or sell. You can see buy or sell. They set a specific price at which they want to buy or sell a crypto asset. So the order only goes through if the market hits that price. So unlike a market order that happens right away at the current market price, a limit order waits on the order book. We shall look at what an order book is until the price matches what the trader asked for. So it's a smart way of avoiding high trading fees and stay in control of your price. I'll give an example. Let's assume Solana. I won't use the exact market price. I'm sure Solana is $150 plus dollars, but let's assume Solana is the current market price of Solana is $10 for the purposes of this class. Let's assume Solana's current market price is $10. But me as Wanjiku, I want to buy this asset or this Solana when it gets to $9. So I'll set up a buy limit order. Remember, you said that the limit order, you can either set it as to buy or to sell a crypto asset. So if I want to buy Solana at $9, I'll set a buy limit order. So what am I telling the system? That once Solana goes down up to $9, automatically buy for me that asset. So I don't have to be on my laptop or my device. As long as I've set that condition, I've set a buy limit order, then the market, or rather the system, will understand that I want to buy Solana once it gets to $9. So it will be an automatic. I don't need to be on my computer. It will be automatically executed. An example, when I want to sell, maybe I have Solana already at $10, but I want to sell all my Solana when Solana gets to maybe $11. So what will I set? A sell limit order. So what am I telling the system? That once my asset, which is Solana, its price gets to $11, sell for me that asset. So essentially, what a limit order does for you, it will execute that condition, whether you're in your computer or not. So that's the second type, a limit order. Then we have what we call a stop limit order. So this is a two-step order made up of what? A stop price and a limit price. So it's a combination of a stop price and a limit price. So think of the stop price like a trigger. So once the market hits that price, your order becomes active. Then it turns into a limit order, meaning your trade will only go through if the price stays within your set limit. So it gives you more control, but there's a chance it would be filled if the price moves fast. I don't want to explain this with an example. When you get to the practical part, you're going to do some practicals at the end of this theory. You'll be able to understand a stop limit order practically. It is best understood when we do it practically. So hold on to that. We'll be back shortly at that. Then we have the next one, which is an OCO. An OCO, one cancels the other. So this order lets you place two trades at the same time. A limit order, remember we've looked at a limit order, and a stop limit order. So as soon as one of them gets triggered and filled, the other one is automatically cancelled. So it helps manage risks and lock in profits. Hold on to that also. Hold on into stop limit order and the OCO. We are going to do that practically in a minute, and you'll be able to understand how these two operate. Then you have what you call the arbitrage. This is when you buy a coin at a lower price on one exchange and sell it at a higher price on another exchange. Let me just show you, for example, how arbitrage is. Let me go to cryptocurrencies. Yeah, let's take a situation, or rather maybe Bitcoin right here. Go to Bitcoin, see the market, so it's been sold. Market like that. So essentially, if I go to markets right here, you'll see that the current market price of Bitcoin on Binance is 94,591. But if I come to another exchange, maybe like BitGet, right here, it's 94,557. If you can see that, from my other device, I can see the numbers are too small. If you can see that thumbs up. Okay, perfect. So you can see from Binance, BitGet, BTC price is 94,591. But if you go to an example like BitGet, 94,557. So essentially, you can see that on Binance, Bitcoin is at a slightly higher price than what you'll get from BitGet. So what a arbitrage is come to BitGet, buy BTC at this price, 94,557, transfer those Bitcoins from this exchange, which is BitGet, to Binance, then sell that at a profit, because on Binance we are having a higher price, so 94,591. So that is essentially what we mean by arbitrage trading. So this is when you buy a coin at a lower price on one exchange and sell it at a higher price on another. So you are earning a quick profit from what? The price difference. Then we are talking about something else we call the leverage. So the leverage lets you borrow money to trade more than what you actually have. So it can increase profit, but at the same time, it also increases the risk. So we'll explore this more deeply when we discussing futures. But just essentially what we mean by leverage is, for example, I'm trading, my trading capital is $10, but I want my position, or rather my margin, to be $100. So I'm less what? I'm less 10x my amount. So what will I do? I'll go to Binance, then I'll use a 10x leverage. 10x leverage means I'm multiplying my capital times 10. So if I had $10 and I want my position to be worth $100, I'll just use a what? A 10x. So my margin now will cease from being $10 and now it will be $100. And this is very important because it helps you increase your profits, but also at the same time, remember the exchange itself is in the business of making money. So they won't lend you money for free. So the more leverage you use, the high risk it is. Now that you're saying it will, yes, increase your profits, but it also increases your risk. But do not worry, we shall look at that when we'll be discussing futures trading. We have what we call the trading pairs. So these are two different coins or currencies you trade in between. So like BTC, you cannot trade BTC alone. You need that asset being pegged to what we call the stable coin. So when it comes to trading pairs, we have two things. We have what we call a base currency and what we call a quote currency. So our base currency, for example, in this example, BTC USDT, our base currency is BTC, Bitcoin. But our quote currency is USDT. And we shall look at when we're doing trading view and think on Wednesday, we shall look at why most pairs are pegged to USDT. Why most pairs or rather, why most base currencies are Bitcoin, Ethereum, Solana, all those. Where most base currencies are pegged to the USDT when we are trading. We shall look at that, why USDT is commonly used. So one is used to buy the other. So in our case, if I want to buy Bitcoin, I'm saying you cannot trade one coin alone. So if I want to buy Bitcoin, and we looked at this when we are looking at ways to acquire crypto. So if I want to buy Bitcoin, I'll need first of all to have USDT in my wallet. So I'll convert my Kenya shillings into USDT for me to be able to swap or rather convert my USDT for BTC. And that explains why we are saying one is used to buy the other. Our quote currency, in this case, USDT. Then you have what you call an order book. An order book is a live list that shows all current buy and sell offers in the market. So it helps traders to see where the demand and supply is. But in short, what I'll rather you to understand an order book as is where all pending orders are kept. Always remember, when you remember order book, remember pending. Pending is the keyword, where all pending orders are kept. Remember when you're talking about a limit order, we said, I gave an example that if I want to buy Solana at the current market price of Solana is $10, but I want to buy Solana when the market goes down to $9. So I'll set a limit order that says when the market goes down to $9, buy for me this asset. So that order or that condition that I have set now goes to what we call an order book. Remember, I'm saying it's where all pending. Remember, the market has not reached $9. So my order, or rather my condition, has been placed in an order book so that when now the market goes down to $9, it will be executed. So where it goes before it gets executed is what we call an order book, where all pending orders are kept. Lastly, we have what we call trading signals. So a trading signal tells you when to buy or sell a coin. So these tips come from expert analysis. I'm very sure you've interacted. If you interacted with the trading signals, thumbs up. Trading signals. So a trading signal is basically if I'm a pro trader and I've analyzed my charts and I've noticed, let's use an example of Solana. I've noticed that Solana, according to my analysis, will definitely go down to $9. I can send to my group or to my group of friends that kindly go and buy Solana or set a limit order that when Solana goes to $9, you can buy in at that, then sell it off at this specific price and collect a profit. So that condition that I'm sending you guys, or those specifications that I'm sending guys, is what we call a trading signal. It's basically a condition telling you, a condition that is made, or a tip that is made by expert analysts that is telling you when to buy or sell a token. So you can find them in apps, newsletters, Telegram channels, WhatsApp group, and all that. So yeah, that is what we call a trading signals. I can see Pius is saying if you've never interacted with a trading signal, is maybe you're ignorant in the group. I see people sending trading signals in the group. I'll send an example of a trading signal after this class. So at least if you've never interacted with a trading signal, you'll be able to understand what a trading signal is. So having understood all the market order types that we need to understand, then we can look at what spot trading is essentially. So what is spot trading? This is the type of trading where you buy and sell assets. It's as simple as that, where you buy and sell assets and make money only if the price goes up after you buy. That's the major difference between spot trading and futures trading. So in short, in spot trading, you only make money when the price when the market is going up or when the price goes up. But when you're in futures trading, you'll notice that you can make profits whether the price is going up or whether the price is going down, depending on the condition that you had set. But in spot trading, for the purpose of this class, in spot trading, what you need to understand that is this is the only type of trading that will make money when the price goes up. So you buy an asset at a certain price, yeah, and if the price increases, you sell it for a profit. I've bought my Solana at $9, yeah. So if the price increases to $12, I can sell off my profit, and I'll have made a profit of how many dollars? I bought Solana at $9. I'm selling it at $13. How much profit have I made? Pius? Yes, $4. So essentially that is what you mean by spot trading. You only make money when the price is going up. But if the price goes down, you lose value on what you bought, but you won't get completely wiped out or liquidated like in leverage trading. Leverage trading is another name or another term used to describe futures trading. So what are we saying? That if price goes down, I'll use my value, but I won't get completely wiped out. So I'll use Solana as my example. So I've bought Solana, one Solana, this is the amount, one Solana at how much? $9. So what happens if my price goes down from $9 to maybe $2? This is what we mean. I'll still be having my one Solana, but what will change? The value of my Solana will have gone down from $9 to $2. And no wonder we are saying your assets become worthless and not worthless. So not worthless, but worthless. Remember when the market was up, or rather when you're buying, your one Solana was worth $9. But because the market has gone down to $2, now you still be having that one Solana, but the value of that Solana will have gone down from $9 to $2. And this is the inverse when it comes to leverage trading on futures trading. In futures trading, if the market goes against you, you can actually be liquidated. And by liquidated, we mean completely wiped out. The assets, the USDT, everything completely wiped out. If you do not have a stop loss, you get completely wiped out. But in spot trading, your assets simply become worthless. They become worthless and not worthless. So what you can do, you can just hold on to your assets. That one Solana, remember the price has gone down to $2. You can hold onto that loss until it recovers that loss. So essentially what we say is that in spot trading, you only lose once you sell. That's the only way you lose. You lose once you sell. Remember, I had my one Solana. It has dropped down. Its value has dropped down to $2. So if I decide to sell, I can decide to sell and get out of the market with that $2, and meaning that I've gone a loss of what? $7. But if I do not press that sell button, I can decide to hold on to my asset until they recover to my initial buying price, which was $9, or even more, for me to make a profit. So you only, two things you need to remember in spot trading: only make money when the price goes up, or rather, let's say three things. You only make money when the price goes up. Number two, you do not lose your assets. What it happens, they lose value. Your assets simply become worth less, not worthless. Then lastly, in spot trading, you only lose once you hit that sell button. So this makes spot trading the safest way or type of trading. I'm actually an advocate of spot trading and holding more than futures trading. But if you find your risk appetite is more and all that, you can always do futures trading. So having explained that, let's dive into spot trading, live spot trading on Binance. So we looked at how to buy assets on Binance. Someone to tell us, how can I buy an asset on Binance? And do not mention spot. I want us to mention what everyone at this point can do. I know some of you guys have interacted with spot, but I want us to mention what everyone can do right now. How you can buy it. Let's say I have USDT already in my Binance account. How can I buy that asset? Any asset, Pius?
Convert.
Yes, the convert option. So let's appreciate Pius. Perfect. So if I'm to come to this part, is it trading, markets, or trading? Yeah, trading. If I come to trading part right here, you can see we have the convert and block trade. So under the convert option, this means I can convert my USDT to what? To any coin that I want. Let's say I want to buy Bitcoin. I can, as long as I have my USDT in my Binance account, I'll come to my convert option under the trading segment like I've done right now. Then I can convert my USDT to what? To my BTC. My USDT to what? To my Solana. My USDT to what? To my Ethereum. But I need us to understand that we have some coins that cannot buy using the convert option. And that's where spot trading comes in. Yes, spot trading can use spot trading to make money, because remember, you're buying low and selling high. You can only make money when the market is going up. So you can do that, but also you can use it when you want to buy an asset. So let's look at that. So if I want to come to spot trading, the same segment, trade, we have what we call the spot trading right here. You can see that, that's thumbs up, the spot trading right here. Perfect. So once you click the spot trading, it will bring you to this interface. And I want us to understand something that I won't teach you all the exchanges, because the interfaces are more or less the same. So if you understand how to operate the spot interface of Binance, you can literally operate any other centralized exchange. You can go to BitGet, the interface looks like this. You can go to MEXC, the interface looks like this. So basically go through the Binance interface, or rather how the spot trading on Binance works. Then you can go and practice on other different exchanges. It's basically the same. The interface is the same. The market order types are the same. Yes. So having understood one, it means you've understood all the other exchanges. So once you want the spot trading what interface, what you're seeing on your screen right now, on the far left, on the far left, we'll have the trading pair. So in this case, we have defined what a trading pair is. So we have said that we have a base currency and you have what we call a quote currency. In this case, our base currency is what? Gala. Our quote currency is USDT. And the purpose of this is that we use one to buy the other. In this case, you're using USDT to buy Gala. So at this far end is where we have our trading pair. Let's say I don't want to buy Gala, I want to buy Bitcoin or XRP. Let's say XRP. So what I'll do, I'll come to the far right here on the search button, and you can see a list of coins that you can trade spot trading right here. But let's say, for example, I don't want to scroll down and look for that coin manually. What I'll do, I'll come to that part and I'll basically type XRP. And it will appear XRP, USDT, and whatever. So if I have FDUSD as my as my what? As my quote currency, I can choose this option. But remember, our quote currency at this point is what? USDT. So this will be my option right there. And you'll see automatically from this far top left, our trading pairs change from Gala USDT to XRP USDT. So below that, below our trading pair segment, we'll have what our current market price is, the current market price of XRP. It will keep on changing because remember the crypto markets are volatile, so it will change. But this is the current market price. On the far left, or rather below XRP, our trading pair, we have what we call an order book. Someone to remind us what we say an order book is. Even if we cannot remember or if the complete term, there's a term I said you should always remember. When we mention order book, what should you always remember? Sly? Yes, pending. Pending. Even if you don't remember anything else, just remember pending. So this is where all pending orders are kept. Pending orders. These are not executed orders. These are pending orders. And the opposite of an order book is what you call, I don't know what it's called, but this part right here. We can call it market trades because they've named it market trades. So the market trades. So these are where executed trades are shown, or rather are listed, where executed trades are listed. So right now, what we mean by executed means that right now as you're speaking, there's someone who has bought for what? It is moving so fast, but there's someone who has bought 72 XRPs at this current market price, 2.59. So these are executed. You can see even the time, executed orders. But pending orders, you'll see even we have a separation of the pending sales and the pending buys. The red ones, pending sales. The green ones, pending buys. It means there is someone who has placed an order type. Which type of order type? Someone. So that you can go to a pending list. Pius?
Limit order.
Yes, a limit order. So there's someone who has told the system that buy for me, what is this? XRP. Buy for me XRP once we reach which price? 2.546. So this is not executed, but it's the condition that has been set by someone. So on the sell side, someone has also conditioned the system to sell for them XRP when it reaches that specific price. So they are not executed, they are pending orders. So in the middle right here of our interface, we have what we call a trading view. Do not worry about this. We're going to discuss this separately as a unit on Wednesday actually. On Wednesday, we shall look at trading view separately, how it works, why we use it, what do we mean by time frame and all that. So do not worry. Just understand by right now that this is what we call a trading view. Trading view. This is basically where traders do their analysis to predict if the price of a coin or an asset will go up and down. So hold on to that. We shall get back to it on Wednesday. So the most important part is this part down here. And no wonder I said we need to understand market order types right here. The limit order, the market order, where is it? The limit order, market order, the stop limit order, and the OCO. And I said we're going to understand practically what stop limit order, or rather how it works and how the OCO works. But let's start with the basic of the basic, the market order type. Higher. Let's separate this into two. We have the buy side and we have the sell side. So let me start with the buy side. So let's start with the easiest of the easiest market order type. We said the easiest is what? Market order. Well, how did you define a market order, someone, before we look at buy market order? What did we define a market order as? A market order. Joseph? Joseph, you can unmute yourself. Okay, I think Joseph has faced some technical issues. Levi?
order to quickly buy or sell at the best available current price.
Yes, as simple as that. A market order type is a type of market order that allows you to buy an asset at the current market price. Current market price. You can see that the current market price, it will keep on changing, but you can see it is 2.1549. So it means immediately I click buy XRP, it will execute at the current market price. Let's do that. I want to buy XRP. I don't want to buy tomorrow. I don't want to buy 5 minutes from now. I don't want to buy when it goes down. I want to buy immediately at the current market price. So what will I do? Come, make sure I've clicked market right there. Then the price, you cannot enter the price manually because it will be executed at the available current market price. So what I need to feed is the amount of USDT I'm willing to spend to buy XRP. You can see my wallet has $50. So what will I do? If I want to use all of them, I can come and manually feed this, maybe say $50 worth of XRP 50. Let me just enter that. 50 like that. I can do that. If I want to use a portion of my money, let's say $10, I can also do that on the same. Then I'll click what? Buy XRP. You'll notice if I'm using $10, we expect that our amount right here will reduce to 40 USDT, but our XRP on this sales side must increase. So remember, we are buying $10 worth of XRP. So if I click buy XRP, it will get executed at the current market price. So let's click and see. So buy XRP immediately. So I've received 4.5 whatever XRPs that are worth how many dollars? $9. I bought worth $10, but the amount above that has been cut is basically transaction fee or market fee, or just basically paying Binance for offering this service to you. So the amount above there has been used as my transaction fee. So basically that's how a market order type works. But I wanted to mention something else. Remember, I can enter this price here manually $10, but I can also use this crossfader. This is also called a crossfader. So a crossfader means, let me sell this so that you can sell XRP at the current market price. Say whole amount. I want my amount to go back to $50. So sell XRP. You can see 49 point something. You can assume that's $50. We've been charged transaction fee. So you can use the crossfader. Remember, you can enter here manually, but you can also use your crossfader. This means if I want to use 100% of my $50, I just slide this crossfader up to 100%. If I want to use 50% of my money, I'll just go to that percentage. If I want 25, if I want whatever, you can either manually enter that amount or use this crossfader down here. So that's how a market order type works. And in this case, not any market order types, but a buy market order type. Remember, I've said we are going to tackle buy side first, then we're going to lastly end this class with the sell side. So what we've tackled right now is how a buy market order type works. Let's look at a buy limit. Remember, we said there's market order types, limit order, and the stop limit order, and the OCO. So let's look at the limit order type, and not any other limit order type, but a buy limit order. So how will we define a buy limit order? An order type that allows you to buy an asset at the price lower. I need to understand that. A buy limit order type, it allows you to buy an asset at the price lower than the current market price, lower. So if I want to do that, I'll come here and click limits. So on this price part now, remember, it can only allow me to buy an asset at a price lower than the current market price. So the current market price is 2.15 whatever. So I can decide to have 2.13. Let's have a uniform number. Backspace 1300. like that. Amount, I want my amount, let's use the crossfader. I want to use only 25% of my amount. That's around $12. So, and I click buy XRP. Where do you think this order type will go? Question, the market order type that we executed, where did you think it went? That condition, where do you think it went? Okari?
Order book.
Let me rephrase again. The market order type that we did a buy market order where the trade was executed immediately at the current market price. Where do you think that trade went to? Joseph? Oh, okay, let's have Thomas to help him.
For market order type, it's executed immediately.
So where did it go? To the order book, or what we said you're going to call it a market trade? We don't have a name for this. We'll call it market trade.
It's a market trade.
Yes, it went under the market trade. Why? Because that was an executed order type. That was an executed order. It got executed immediately at the current market price. But when it comes to this condition right here, remember it will not execute immediately because you are telling the system to buy us XRP when it goes to which price? 2.130. So it's not executed. So it will go under the order book because we said that the order book is where all pending, that's the word, pending orders are kept. So let's do that. Let's do that and see. So we are telling the system to buy us using 25% of our $50. That's around $12. And I'll click buy XRP. So let's see what happens. So if you've noticed something, that it has gone to open orders down here. It has gone to open orders. If you can remember when we were doing the market order type, the condition did not come down here because that was executed immediately. So for this buy limit, it has opened an open order. So let's interpret this. So the order was opened right now. Which pair? XRP USDT. Which market order type? A buy limit. A buy limit order type. Price. So what are we telling the system? That once XRP right now is 2.16. So we are telling the system that when XRP goes down and taps 2.130, kindly buy that asset for me. Then the total USDT that you've committed into this condition is what? 12.78. So what essentially this means is if XRP never comes back to 2.130, this order type will never be executed. It will stay here until you yourself comes and closes it. So in this case, if you want to close this, or rather if you want to cancel this condition, or this condition that you've set or you've told the system to do, you can come and close it right here. This is very nice because you don't need to be, if I leave this here, I don't need to be on my computer or connect to the internet. As long as XRP taps 2.13, my condition will be met and will be executed. I will have bought XRP at this specific price. How do we cancel this? On the far, is this left? On the far right, there's a dustbin button right here. Just click on that and you will have cancelled that condition. If you understood the buy limit, thumbs up. If you have understood a buy limit, thumbs up. Okay, perfect. So let's look at a buy stop. A buy stop. We've looked at buy market order type. A buy limit allows you to buy an asset at a price lower. Need to understand that lower than the current market price. So let's look at a buy stop limit. If I want to do that, I'll go and click buy stop limit. So what's a buy stop limit. A buy stop limit, it allows you to buy. Remember, the buy limit allows you to buy an asset at a price lower than the current market price. But a buy stop limit allows you to buy an asset at a price higher than the current market price. Higher than the current market price. So it means if XRP current market price is 2.159 something, whatever, I can only buy this asset at a price higher than this price right here. And someone would ask, why would someone decide to buy an asset at a price higher than the current market price? So basically what happens is you're bullish on that asset, or rather you've done your analysis and you've noticed that once XRP taps, for example, let's assume a price higher than this current market price is $3. You've done your analysis and you've noticed that once once XRP hits $3, there's no it's going down. The direction from that $3 will be upward. So your target price is once it reaches $3, buy for me that asset, because I know from that $3 the direction will be up. And I'll give an example, a logical layman's example. If you go to these Matatu stages, you'll notice that the Makanga touts, yes, that the touts have mastered this thing. They have understood that if they have an empty Matatu on the road, people will not board that Matatu. So they actually pay people to do what? To fill in the seats, and that will psychologically manipulate the travelers that this bus is actually on the verge of leaving. So what will happen? The travelers will actually board that Matatu. Will board that Matatu because it's on the verge of leaving. The verge of leaving. That's the same thing. The asset is on the verge of going up. Yes, they also traders, Joseph. They're on the verge of going up. So you buy an asset at a price higher than the current market price. The same thing. They notice that you cannot board the Matatu if it's empty. So they'll pay people to enter. Then they'll psychologically manipulate you to think that the bus is going, or rather it's on the verge of leaving, and you'll jump into that wave. That's the same thing. You want to jump in on the wave. You've noticed that this asset, once it reaches $3, it will do what? It will only be parabolic from that level. So you want to jump in at that high price than the current market price. Perfect. So let's now understand how this works. If you click on the stop limit, you'll notice that it has opened two prices, a stop price and a limit price. And I need you to understand this. The limit price is the actual price that you want to buy this asset at. For example, in our condition, remember you said it allows me to buy an asset at a price higher than the current market price. My current market price is 2.16. But my target price, I want to buy this asset at $3. Once XRP reaches $3, that's where I want to buy this asset. So always understand and always remember that the limit price is the actual price that you want to buy this asset at. So that's where you enter this. I actually prefer starting by entering this price right here. So I'll say my price will be 3.000, like that. Higher. So what is a stop price? A stop price is a trigger price that is lower than the limit price. I don't want you to get confused. So a stop price is always a price lower than the limit price. So I'll come and enter a price just lower than this, maybe 2.9999. A price slightly lower than the limit price. What does this help in? So a stop price is basically what you call a trigger price. And what does it trigger? It triggers the limit price. So what essentially it does, or the purpose of this is, it tells the system that once the XRP, let me just use real examples, what you are doing. So it is telling the system once XRP touches 2.9999, kindly send my condition, which is to buy XRP at $3, to what? To my order book. I repeat that again. A stop price is a trigger price that is always lower than the limit price, slightly lower than the limit price. Okay. What is a limit price? A limit price is the actual price that I want to buy this asset at. And in this case, I want to buy my asset, which is XRP, when it taps $3. So, what does the stop price help in? So, the stop price is essentially telling the system that once XRP touches 2.999, send my condition. What is my condition? To buy XRP once it taps $3. So it will send that condition to my pending order, which is under my order book. So remember what we said, if you want to amount, you can use the crossfader. Let's say we are going to use 25% off my money. So I say buy XRP. Let's see what will happen. I'll say confirm. Perfect. So it will open this condition down here. Let's interpret this condition. Number one, this is the time that you've done that. This is the pair XRP USDT. The order type, this is stop limit order type. The stop limit order type, or what Binance is calling is stop loss, but you can call it just stop limit order type. Then it's on the buy side, the price. This is the limit price, the actual price that I want to buy XRP at. I want to buy XRP once it hits $3. What amount am I ready to buy XRP with? $12. So the actual price that I want to buy XRP at is $3. Once XRP reaches $3, kindly buy me this asset. But I'm having my trigger conditions, or what you're calling our stop price. So I'm telling the system that once XRP reaches 2.999, send this condition to my order book, so it can become a pending order. So if you understood up to that part, thumbs up. If you got 10. Mogare, have a question? You can see your hand is up.
Yeah. Question.
Yes.
Is it okay to assume that, or to say that this can be interpreted to be something that is used for price manipulation, because some traders can make those orders to indicate that the price is going up for a particular stock? Because why would you want to buy a stock at a higher price?
Yes, they can be used for manipulation, but also remember, there are people who know that once, for example, there are people who know that once Bitcoin reaches 100K, there's no way we are going below that again. Maybe you are going to maybe 110 and something. So because they don't want to risk, remember these are, no wonder it's on Binance and they've given it as a form. They understand they can use this to manipulate, but they've kept it here because they also understand there's someone maybe like me who is not ready to risk to buy Bitcoin right now because I fear it might go down maybe to $60. So my condition is once it gets to, because I'm certain, once it gets to $100, the only direction will go is up. So they are giving me an option of setting that condition, that once that price is reached, I can actually dive into that wave and ride the uptrend. Is that okay? But yeah, I agree. It can be used to manipulate the market. Joseph?
The stop limit. I think before I have done that. Let us take an example of Bitcoin at the price of $4,000. If you feel that maybe the price, if it dips below 90,000 mark and reaches, but if it dips below 90, it might reach 80. You can use the stop limit. The stop be 80. The stop be below 80. Then the limit be, let us say, 80. Can it work?
Yes, but that will be on the sell side. Remember, we're on the buy side for now. Oh, I didn't get you.
Okay. stop limit order.
Rephrase again.
Let us say you set a stop limit order,
What's
and the stop,
Bitcoin at that moment?
the current market price is 94,000.
Yes.
Then you feel that if the price dips below the 90,000 mark, the price might go to further to collect maybe liquidity at 80,000 mark.
Yes.
So can you set the stop at 89,000, let us say even 82,000, then the limit be 80,000.
Okay. Just to correct you from the word go. From the word go, what you're saying is very correct. You can do that when you're on the sell side. Remember, we are talking about the buy side, and I'm strictly define that the buy stop limit order only works in what? When you want to buy an asset at a price higher than the current market price. Having a condition right here, you're saying that BTC is at $94. So there's no way I can set a stop limit order at a price lower than $94 when you're on the buy side. Remember, I've said the buying stop limit allows you to buy an asset at a price higher. Only works like that, higher than the current market price. But if we're talking on the sell side, which we have not discussed yet, that would actually work. Is that okay? And you'll understand why. In a minute, we're going to tackle the sell side. Sly, you have a question?
Yes, logical. I want to ask you, which one do you prefer at a personal level, limit or stop limit?
Limit, obviously limit. I prefer buying an asset at a price lower than the current market price. Me and those guys for buying when the market is down. When the market is bloody, that's the time I buy.
Yeah, because stop limit sounds complicated.
Yes, stop limit is complicated, but it works for some people. Plus also I had to teach it so that when you come to this part right here, you don't get confused what you mean by stop limit and all that. But limit order should work. Yes, perfect. So having understood what a stop limit order is, now the last thing on the buy side, which is an OCO. I don't want to talk about a trailing stop loss because I don't think someone will ever be using this. But essentially what a trailing stop limit order means is what you want to collectively collect profits. What do I mean by this? For example, I've bought XRP at $3, but I'm not sure. I want to collect profits at $5. I want to collect profit at $10. I want to collect profit at $15. So I can use a trailing stop to do that. So every time a portion, when you get to $5, a portion is sold, I collect my profits. When you get to $7, a portion is sold. When you get to $10, a portion is sold. So that is not a complicated one. What I want us to cover is an OCO. An OCO. And if you remember from the notes we said, is an order type where one cancels the other. But the most important thing to understand, or rather to remember, is that it is a combination of the two order types that we've already covered, a limit order and a stop limit order. And this juncture is what I want to remind you, that a limit order, this is the difference between a limit order and a stop limit order. A limit order allows you to buy an asset at a price lower than the current market price. But a stop limit order allows you to buy an asset at a price higher than the current market price. Limit order, lower than the current market price. Stop limit order, higher than the current market price. So an OCO essentially is a combination of the both. So let's look at how it works so that you can understand how it works. So come on this part, select OCO. OCO. Higher. Let's define some whatever. What do we call? Some terms right here. So we have the TP limit, the SL trigger, and the SL market. So what do we mean by this? Higher. The price, the TP limit written right here, I don't want you to get confused by this. I just want you to understand The TP limit here, remember you said is a combination of the buy limit order and the buy stop limit order. Higher. I want you to understand that the TP limit is always the buy limit order. What do you say the buy limit order is? It allows me to buy an asset at a price lower than the current market price. So this condition right here will be set as what? A price lower than the current market price. I want you to understand that an OCO is for a confused, this condition is for a confused person, for lack of a better term, a confused person. They want to buy this asset when the price goes down, but they also fear that maybe this asset will not go down, it will continuously go up. So they have set a condition for 2. When the price goes down, buy for me. But if it doesn't go down, it goes up, also buy for me when we reach this certain price right here. So now what I'm saying, the limits, the TP limit is what? The limit order type, which we are calling what? The price higher than the current market price. So here, right here, this is where we're going to insert our current, a price lower than the current market price. So let's do that. Let's say 2.3. 2.1, a price lower, let me just say 2, because now it's 2.000. Remember, this is the current market price, so it should be a price lower than the current market price. Higher. It's a combination of a buy limit order and a buy stop limit order. And remember, on the buy stop limit order, we had 2 prices. We had the limit price and we had the trigger price, what we call the stop price. So remember, the limit price is the price that I actually want to buy this asset at, a price higher than the current market price. So I can have this as $3. 3. But for me, I need a trigger price. A trigger price, meaning that if that price is reached, then it will send my limit price to what? The order book. So I can have this as 2.999. Amount of whatever, I can use the crossfader or manually enter that. Then I'll click, let me just cancel this so that you don't get confused. So I'll click buy XRP and it will open 2 order types. Remember, we said that an OCO is one cancels the other. We'll understand what we mean by that. So let's interpret this so that we can understand this better. So the first condition, remember, we said that an OCO is a combination of a limit price and a stop limit price. And because this said on the buy side, so it's a combination of the buy limit and the sell stop limit market order type. So as we explained how the limit order works, so you're saying buy for us XRP when XRP reaches what price? $2, a price lower than the current market price. So I want to buy this XRP cheaper. So I'm telling the system, once XRP reaches $2, buy for me that asset. Number 2, I have another condition. I'm very bullish on XRP. I just want to buy at a price higher than the current market price. So I'm telling the system, buy for me XRP when it taps what? $3. But I have this condition right here. And this is the trigger condition, that once price taps 2.99 whatever, send this condition. What is my condition? To buy XRP at $3 to my what? To my order book. So why do we call this once cancels the other? The condition between these two that will be met first, that is the one that will be executed, whereas the other will automatically get cancelled. So it means that if XRP touches $2 first, this condition will be the first one to be met, and once it has been executed, this other one will automatically get cancelled, and vice versa. So if XRP touches $3 the first, then it means this condition will be executed first, and my limit order condition will automatically get cancelled without being filled. Remember how we said we cancel this condition? You just click the dustbin buttons right here and you'll cancel that order type. If you understood how an OCO works, thumbs up. I've tried to explain in the simplest of the simplest English, or rather how best I could. Slide.
I wanted to ask you, from your experience, what's your experience with OCO?
How often do I use OCO?
Yeah.
I'll be honest, I've never even actually used OCO. Because me mostly I only use the limit order type. I always buy my assets at a price lower than the current market price. I've never used the OCO, honestly. Yeah, perfect. So if you want to cancel that, cancel. Perfect, like that. So that's all about the what? The buy side. Let's look at the sell side. The sell side now, normal, just works the same as just the opposite of the buy side. But now this is the sell side. So let's start with the simplest of the simplest, the market order type. In this case, not just any market order type, is the sell market order type. So if I want to sell my assets, let me just buy. Do I have some XRP? Let me buy some XRP right here so that we can have something to work with. Let's say 50% by XRP. Yeah, I have some XRP now, 11 XRP. So I want to sell my XRP at the current market price at 2.550. So which condition will I use? The market, the sell market order type. So I'll make sure I've clicked market, then I'll come to this part, use my crossfader and say maybe I want to sell 100% of what? My XRP, or maybe 50%, or maybe 25, let's say 25% in this case. Then I'll click XRP. It will sell my 25% of my XRPs at the available current market price. So I'll say sell. You can see automatically market sell order has been created. And if you look at our balance, only 18 USDT, or rather only 8 XRPs have remained. We had 11, so 8, 9, 10, 11. So 3 XRPs have been sold for USDT right here. Higher. That's the market type, the simplest. Thomas?
Quick question, just for the purposes of understanding. If, let's say I'm selling, I can see the order book has quite thousands. Somebody is selling 500,000.
Yes.
Will the system aggregate from the small orders to fulfill that buying of that junk? Or will it wait for another person who has a bigger amount to buy from? Just to understand how it works.
Okay, just to understand how it works. So, remember we said the advantages of trading on centralized exchanges versus decentralized exchanges. And one of the things we mentioned is that on the centralized exchanges, there's liquidity. And what do we define liquidity as, someone? What did we define liquidity as? The simplest of the simplest ways to define liquidity. Pius?
The ease of buying and selling a coin or a token in the market.
Yes, the ease of buying and selling a token. So even if you come to, you can see it, someone has sold 10, 6, this is actually buying. Someone has bought USDT worth $4, XRP has gotten lost. They're coming in so fast. But you can see there's someone who has bought smallest amount, like $3, or what you are using right here, $10. But at the same time, you have someone who was buying at 13K. But at the same time, there's someone who is selling that asset at $16, at 16K. There's someone at 21K. There's someone at 8K. And there's someone also just like us right here, selling at what? At XRP worth as small as $2. So that liquidity is basically what is happening. It's just like if I want to buy a pen, I have to look for someone who's actually selling a pen. The one who has a pen wants money. But me who has money, I want a pen. So we are basically exchanging that. So the people who are selling, they are selling to people who are buying. And people who are buying from people who are actually selling. So that's why we said that it's good to trade on centralized exchanges because of liquidity. You can see a lot of people are transacting through this Binance exchange. So there's no way you'll come to this exchange and lack someone who is, if I'm selling, I'll never lack someone who is actually buying. And if I'm buying, I'll never lack someone who is actually selling. Is that okay, Thomas? But if you go to the decentralized exchanges, you might find you have an asset, you are actually in profit, but you don't have someone to sell to for you to collect that profit. I hope I've answered you, Thomas.
Yes, it's clear. It's a shared pool, so you hide from the pool.
Yes. Essentially. But in layman's terms, what I've explained. I have assets, you don't have assets, you want this, I want this, we basically do an exchange. It's as simple as that. So going to the next type of market order type, which is the sell limit. Sell limit. So in this case, a sell limit allows you to sell an asset at a price higher than the current market price. So it allows you to sell an asset at a price higher than the current market price. And that's why a sell limit order type is called a take profit, because you're taking profit. You are selling your assets at a price higher than the current market price. And I'll use this example. I've bought these XRPs just right now at 2.1555. So if I want to use a sell limit order type, remember I've said is a price is an order type that is used to sell an asset at a price higher than the current market price. So to come here and set $3 right there. Amount of XRP, let's say I want to sell my whole amount of XRP. So I say sell XRP. Let's see the conditions that you've set, or rather let's interpret this. So I have the XRP, I want to sell them, but I don't want to sell them right now. I want to sell them once XRP taps what? $3. $3. That's the price I want to sell my XRP at. So you will find now, no wonder we're calling it a take profit. I want to sell at $3, but I bought what? At the current market price that was around 2.15. So it's a price higher than the current market price. So if someone tells you set a take profit at this, they're essentially telling you set a sell limit order type. If you understood that, thumbs up. A price higher than the current market price. Okay, perfect. So if you want to cancel that, what we said. Let's look at the third one, or rather the second last. The stop limit. The stop limit. Not any other type of stop limit, but the sell stop. So I'll come to this part, sell stop. Higher. Remember we said we have two types of sell. Under the sell stop, we have two prices. Or rather, what we like call this? Yes, two prices. We have the stop price and we have the limit price. The stop price is the trigger price. So, but the limit is actually the price at which you want to sell this asset. Remember when you're on the buy side, we said it allows you to buy an asset at a price higher than the current market price. And you're asking, why would I buy an asset at a price higher than the current market price? So when you come to the sell side now, it's basically the inverse. It allows you to sell your assets at a price lower than the current market price. Lower. Remember, the sell limit allows you to sell an asset at a price higher than the current market price. And no wonder we've called it a stop loss. If you can remember, a stop loss. Price higher than the current market price. What we've demonstrated the last few minutes. But with the sell stop limit, it allows you to sell your assets at a price lower than the current market price. And no wonder it's called a stop loss. Let's try and understand this. I've bought maybe some assets at 2.500. I'm fearful that the price might go down to maybe 2.13. So if I want to cut down my losses, I'll set a sell stop limit. It is basically used to cut down my losses. So let's do this practically so that maybe we can understand a price lower than the current market price. So remember, I said the limit price is actually the target price that you want. So it should be lower than the current market price. So I can say 2.00. Let's say that. But the stop limit is the trigger price. That is always a price slightly lower than the limit price. So I can have this as 1.999. Amount of XRP, I want to sell all of them. Perfect. I want you to notice something. Before, yes, yeah, perfect, I've seen. So all of them, I want to sell all of them and say sell XRP, say confirm. Perfect. Let's look at these conditions right here. So I have my assets, but I'm fearful. I've bought my assets at 2.15, but I'm fearful that XRP might go down. And what I'm telling the system is, if XRP goes down, I'm ready to give up, or rather, take me out of this trade once it gets to $2. Instead of me waiting for this XRP to go down up to 0, which is impossible, but let's use for the purpose of understanding, instead of me waiting for XRP to go up to 0, I want to part, or rather, I want to cut my losses once it reaches $2. So yes, I understand I bought my assets at 2.15, but once I reach $2, if XRP dumps to $2, kindly sell my assets. I'm ready to part away with that loss. But I have a condition right here. The purpose of this trigger price or the stop price is basically to do what? To tell the system that once XRP dumps to this price, send this condition to the order book. If you understood that, thumbs up. If you've gotten that part, yes. Thank you. Perfect. Let's go to the last. Remember how to cancel that? Just like that. So let's go to the last one, the OCO. One cancels the other. And essentially what we said, an OCO is a combination of what? A limit price and a sell and a stop limit. But in this case, because this is a sell OCO, is a combination of a sell limit order type and a sell stop limit order type. So our limit price, remember what we said about the sell limit price? The sell limit price is a take profit. So it's a price higher than the current market price. So I can have that as $3 or maybe even $3. Then what did you say about a stop limit price? It's a stop loss. So it's a price lower than the current market price. So I can have this as $2. I can say $2. But I have to have my trigger price. The trigger price is to trigger this limit to go to what? My order book. So I can have that as 1.999, like that. What amount of XRP? All of them. I actually want to sell all of them. Say sell. It will open two order types. Now I said an OCO is for confused people. For example, this person is fearful that if XRP goes down, not even confused, he's actually safer because he's fearful, this person X, is fearful if the market goes down, kindly, let me take my losses, let me cut my losses at this specific price. So they have a stop loss, but also at the same time they're telling the system, if the market goes up, I also want to collect my profit at this specific price. So the first condition is for take profit, the second condition for a stop loss. So let's interpret the take profit. So they are telling the market that if XRP goes up to $3, let me collect my profit. Sell my assets when XRP touches $3. But if XRP doesn't touch $3, it goes down, kindly, this is my stop loss. I want to cut my losses at this price. So if XRP touches $2, please sell my assets. Let me cut my losses from that juncture. But remember the purpose of the trigger price? You can see the purpose of the trigger price right there is what? 1.99, meaning that once XRP touches this, it will send this condition to the order book. And how the order book works from just the full, not order book, the OCO works from just the full definition of it, which is one cancels the other. It means between the two of them, the one that will be executed the first will automatically lead to the cancellation of the other. So if XRP touches $3 the first, this condition will be executed, whereas this second condition will be automatically get cancelled. The inverse is the same. If XRP touches $2, this person will be stopped out of this trade, or rather they'll cut their losses at that juncture, and it will automatically cancel this first condition. Thomas, you have a question?
Yeah. Can I set instead of using the stop loss value, I can as well use the market. In which case, if my trigger is 1.999, and then maybe that's the time the market price hits the same value, I could collect my money at that time. Or the market value could be slightly different from the 199, but still that can be the option.
Okay. The purpose of this is, remember, you'll not always be on your computer 24/7. So this is actually safe because what you're saying, you can use the market order type, but maybe XRP might tap $2 when you are asleep, maybe 12 a.m. You'll not be on your system. So you'll not be there to manually do this, to use the market order type. So this thing helps you. For example, maybe some other condition will be out of your control. You may be awake, but there's no light, there's no Wi-Fi or stuff like that. So having your condition like this, it means you will be moving around without fear of anything, because you know you have your stop loss and you have your take profit. So you know, even if the market goes down, you're fearing nothing because you know you have a stop price, or rather what you call a stop loss. And also, if the market goes up, you also don't fear anything. You know you have your take profit at that juncture. So this basically is, if you not be on your computer, or rather your system, because of 1, 2, 3 reasons, you are basically safe. You have set your conditions, and you know if the market goes up, you're safe, and even if the market goes down, you're equally safe. Is that okay? Perfect.
Yes, that's okay.
Yes. Any question? Any other question? Joe? Joseph, I can see your hand is up.
Is the trailing stop loss same as trailing stop?
Pardon?
Is the trailing stop loss same as trailing stop?
Yes, it's the same as trailing stop.
Oh,
Yes.
let us take an example. We bought TC at the time it was 20k. And can you set a trading stop loss 20% behind the current market price, so that the moment the BTC reverses 20%, your stop loss remains at the 20% mark?
Yes. Okay. The reason why I'm not covering the trading stop loss and I'm leaving that to people to research is because I noticed there are some changes that they've done where they don't allow on the sell side, but they allow that on the buy side. And I wanted to understand why. But logically, I don't know why, but logically, what I'm thinking is because, remember, even Binance is on the business of making money. So if they give you an option that every time the market goes up, you collect a certain profit, it goes up again, you collect a certain profit, or when the market is going down, you can have a trailing sell stop, it will basically keep them out of business. It doesn't make sense. No wonder I found that it doesn't work on the sell side, but it works on the buy side. So I wanted to try out with Mexi or another exchange, then I can give you updates on the same.
Okay.
Is that okay?
Yeah.
Yeah. Any other question? I know maybe today we've dived into a lot of things, but they're not hard things. If you rewatch this video, you'll be able to understand all what we've covered today. So if no other questions, I'll end this class at this juncture. We meet tomorrow. Tomorrow we're going to look at candlesticks. So let's meet tomorrow. Bye bye, guys, and have a good night.
Good night.
Good night.
Good night.
All right.